a massive shift is rocking the global financial landscape. For the first time ever, the probability of the Bank of Japan raising interest rates in June has skyrocketed above 95%. By the end of this video, you'll grasp how this pivotal percentage point could unleash a global liquidity squeeze and what the staggering 48 trillion yen wipeout in the Nikkei means for your investment portfolio. We are witnessing a historic pivot in Japanese monetary policy. So, why is this happening now? The Japanese yen has been under relentless pressure, recently breaching the crucial 160 mark against the US dollar. This extreme weakness is compelling the Bank of Japan to act. Traditionally, the BOJ has been the last stronghold of ultra-low rates, fueling the global yen carry trade. However, with inflation and currency pressures mounting, the central bank is gearing up for a move that many thought was still months away. The upcoming mid-June meeting is now the most anticipated event on the macroeconomic calendar. The mere expectation of this hike has already sent shockwaves through the equity markets. The Nikkei 225 fell by an alarming 4% in just one day, erasing a staggering 48 trillion yen in market value. This sell-off wasn't limited to Japan. It triggered a wave of selling across Asia, signaling a potential unwind of global risk assets. Historically, every time the BOJ has raised rates in recent cycles, stocks have plunged between 10 to 15% within weeks. We are on the brink of a timeline where the June meeting could catalyze a broader market correction. On social media platforms like X, the sentiment is reaching a boiling point. Traders are describing the current climate as a bloodbath, with one prominent crypto analyst warning that the 48 trillion yen wipeout is just the beginning. The consensus among market participants is shifting from mere curiosity to outright alarm. Many are sounding a final warning that breaking the 160 level in US dollar to Japanese yen, combined with the June 13 policy meeting, could signal the beginning of the end for the current bull run. The phrase yen carry trade unwind is now trending as investors rush to hedge their positions. Professional analysts are drawing attention to historical parallels. One investment strategist pointed out that since 2024, every BOJ rate hike has been followed by a substantial drop in Bitcoin, averaging a 29% decline. Specifically, in March 2024, BTC fell over 20%, and in December 2025, it plummeted nearly 34%. Financial institutions are emphasizing that this hike isn't just a Japanese issue, it's a matter of global liquidity. When the world's cheapest source of capital, the yen, becomes more expensive, risk assets, from US tech stocks to cryptocurrencies, feel the squeeze almost immediately. Domestic Japanese stocks are at the epicenter of this volatility. The sudden 4% drop in the Nikkei is especially hard on major exporters who thrived in a weak yen environment. A rate hike creates a double-edged sword. While it may stabilize the currency, it also increases borrowing costs, threatening the broader index's valuation. Analysts are closely monitoring psychological support levels. If the BOJ confirms that 95% probability with a hawkish tone, we might witness a repeat of the historical 12% drops seen during previous volatile periods in 2024. The risks may not be limited to just charts, they begin with the yen. US dollar to Japanese yen trading above 160 is an alarm bell for the US Federal Reserve as well. A sudden repatriation of Japanese capital could adversely impact US treasuries and equities. This is the dreaded carry trade unwind that traders fear most. The overlap between the BOJ's meeting and upcoming US Fed decisions creates a high-tension scenario. If the BOJ takes aggressive action while the Fed maintains its hawkish stance, we could see a contraction in global liquidity that is unprecedented, affecting everything from emerging markets to the Nasdaq. For individual investors, risk management is now more critical than ever. Keeping a close eye on the 160 level in US dollar to Japanese yen is essential. Any breach could trigger immediate BOJ intervention or an emergency rate hike. Historical data shows that during these pivotal moments, cash often reigns supreme. Diversifying away from highly leveraged carry trades and monitoring Bitcoin's response, often a leading indicator for liquidity, could be vital strategies. It's wise to avoid chasing dips until the BOJ's tone is fully clarified on June 13th and 16th, as the historical range of a 10 to 15% equity drop remains a significant threat. Our AI model has analyzed 3 potential scenarios for the June meeting. In the base scenario, the BOJ raises rates, leading to immediate market volatility but stabilizing the yen around the 155 level. In the bear scenario, a hawkish surprise triggers a complete carry trade unwind, potentially causing a 12 to 15% drop in the Nikkei and a sharp correction in US tech stocks. In the bull scenario, the BOJ manages a dovish hike, raising rates but signaling a slow pace for future moves, which could allow markets to recover after an initial shock. The key differentiator will be Governor Ueda's guidance on future liquidity. In summary, BOJ hike odds are at a record 95%. The Nikkei has already shown signs of danger with a 48 trillion yen loss, and the yen carry trade stands at a breaking point. Stay tuned to this channel as we monitor the results of the mid-June meeting. If you found this deep dive insightful, please subscribe and hit the notification bell to stay updated on Japanese markets. What's your strategy if the BOJ hikes? Share your thoughts in the comments below.